Hey everyone, welcome to another review. And we have a gap down in equities, we have a spike in yields, and we have dollar going up surprisingly, which is all pretty strange, and also oil going up. And why I say this is strange because this is the jobs market hot, inflation hot kind of expected behavior. So I'm thinking maybe the jobs data leaked and the market is moving ahead of the actual print. Which is quite strange. And obviously, equities would not like that because it means no cuts and also going down. The only recourse for equities is to tantrum, and this means dropping a lot quickly. This was my prediction from last week. Obviously, I didn't. We moved before my prediction. I think I had this. Actually, this was higher. This was like this. So something like this. I thought we would break this trend line and go below next this week, but we did it earlier. And we went even lower, almost to the 21 EMA here. We also have a ghost print at open. I'll turn off the ribbon to get the idea. Uh, we also have a ghost print at open at 64, 644.97, and most likely we will bounce back to this level and then start going back down again. And mm, now we are basically building this rounding top kind of thing here. We've been making slightly higher, sorry, back to 30 minutes. We've been making slightly higher highs, so went here, slightly higher, slightly higher. Now it is time to make the slightly lower highs before and finish off this rounding top before we break down. But obviously things can change quite a lot. And we always move faster on the way down than on the way up. So it can be a slow rounding top that takes like a week or two, or we can be like even today we can go down much lower to this 635 area if the market wants to. So I'll delete this. It's no longer relevant. Expectation is something like this. So we go back up to fill this gap, and then we should go back down. Maybe do something like this, but eventually we should break down and continue on the rounding top kind of theme, which I think we will get eventually. First here, then we bounce again, and then we actually this should be a lower bounce now. So something like first of all this. Bounce here, get rejected again. Probably like a breakout, but it won't be that much. And this area becomes resistance. Eventual breakdown here. We go here, another one, and full breakdown later on. Um, yeah, so something like this uh, with the whole setup eventually. Now, this being said, we also have VIX moving up, and it is above the ribbon. I expect this to fade a bit, and but this time I don't think it will go below this 55 EMA, which is 1669, maybe slightly lower, as low as this, but I would expect this time like 16 becomes support. Obviously we can overshoot, but eventually we will break out and go higher. And finally, we have crypto with the green setup, but this doesn't mean anything or doesn't is not that meaningful because when we break down, the ribbon becomes resistance, and this is kind of like the third rejection that would come, like one rejection, second rejection. This would be a third rejection, and the third rejection is usually fatal, and we break down and make new lows go to 100k at least. And you can see it here as well, like becoming resistance. We can see it at this top as well. Yeah, like one, two. The third one was fatal, and we made new lows. Um, the surprising thing is like how bad yields are doing. Like TLT down 1%, gapping down 1%. Pretty strange. So like I said, this looks like a hot inflation print and hot jobs market kind of setup, especially with DXI. When we got the jobs market print last time and it was weak, DXI dumped because weak jobs market equals less growth. So DXY is now reflecting growth concerns. When if US growth is good, DXY will be up. If US growth is bad, DXY will go down. So pretty strange that we're seeing this happening right now. And again, it leads me to believe that we're getting a leaked jobs market. So this would be the general thing here. I want to talk about a different subject right now today, and it's M2 versus SPX versus inflation. So you know that quote from Milton Friedman with inflation is always a monetary phenomenon, which means when people have money, or people in general, or anyone has money, that creates demand, and if that demand is not met with supply, and it is not when you get spikes in the money supply, uh, then prices go up because there is too much demand. And this is M2, which has been starting going up again. But what we can see here, this is UACPI, the exact value, and this is data going back to 1959. There's obviously more data before, even if we haven't tracked it, but this is the most data points we have, and have to use this. So UACPI from 1959 until today only increased 10x, in spite of the money supply increasing 76x, which is pretty strange. But then we look at equities, and equities have increased 113 times in the same interval. This is SPX. So the money supply has created inflation, but not in the real world, so to say, because financial assets are not included in M2 or inflation calculations. Basically, all the money created through M2 has gone into equities or financial assets in general, and has created a huge inflation there. But because those are not included in the inflation calculation, it looks like we don't have inflation. The inflation exists, it's just in equities. Another thing to note is that these two are generally correlated, and whenever we have deviations to above or below, we eventually mean revert. This is also a moving target because, like for example, here we were very oversold relative to M2, and we started going back up, but and eventually hit a mean reversion. But because M2 continued rising, it took from, what's this, like 2009 until 2017 to finally catch up, and obviously we went into overshoot on the other side. Another thing to note is that there are various regimes for this, like for example, since the beginning, this is tracked until the 70s. We had a relatively stable growth. Then from the 70s, we went until like 82 on relatively stable growth, but accelerating. Then we accelerated again from the 80s period. Sorry, from the 80s period until the 90s period, like something like this. A flattening in the 95. Then we have the Asian currency crisis, the peso crisis in 95, 96, and we accelerated again. And this happened until, actually, this was, no, it's good. This was until the financial crisis, and then we have another steepening of the, or another acceleration here until COVID, and now it looks like this. So we have entered the new regime. The slope is pretty steep, and this is very bubbly. But then again, we have deviations. So for example, on at the 2000 top, the values were, so M2 had increased relative to the starting point by 15x, almost 16x, and equities by 26x. And we have 1580 divided by 2636, and then we subtract 1, and equities had a 40% premium relative to M2. And we know what happened next. We mean reverted, and we even overshot a bit and went below. And this was a bubble popping. In 2008, surprisingly, we were in almost at M2, but it kind of became resistance, and we went down quite a bit here. and the overshot was massive. Like, oops, not this one, the replay bar. Pushing into view, and again we have like 12.5 divided by 2797 and minus 1. So equities were 56% undervalued relative to M2. And what followed was a huge bull market that lasted for a very long time once we caught up with M2. This was the 2022 top. We were once again slightly above this. We corrected, and you may ask, where are we now? So this is until July, the beginning of July. So it's not quite up to date. And we have 7616 divided by 11322 minus 1. So we are 42% overvalued on equities relative to M2, and we would have to mean revert. And this is actually more probably like 34% because we also went higher since then. So we are 44% overvalued, very close to what we were in the 2000 bubble. To match the 2000 bubble, I calculated this beforehand. We would have to go to 6780 on SPX, but because it will keep going higher on M2 as well, it's probably higher, like 7K, something like this, depending on how fast things go up. But we are definitely in a bubble. It doesn't have to match the 2000 period uh, exactly, but most likely when we will correct, we will overshoot. And just to get to quote unquote fair value at this time is probably like 4300. So 442, 4300, depending on how you look at it. So to match fair value, we would have to drop like 35% on SPX right now. And again, most likely we will overshoot, take it to 50%. That's 4K. So that's if we if the bubble pops and we start dropping, like 4K would be where we target, not 4K here, but 4K on SPX. Regular. My target was 67 something something, so pretty close to that 67.80, and pretty, that will become more than 34%, and getting like to 4K is 40%. So this would be the expected drawdown if the bubble pops. Like we go to 4K, and then we see, which is approximately the 2022 low area, and I think this will become support, like this into this. Somewhere in this range, we will find a bottom, and then go higher. Now, this information is useful, but without a timing, we don't know. So this could happen today. Like nothing is preventing us for this triggering and starting today, or it can happen one year from now. We don't know the timing, but as a general principle, I will use this as a benchmark. If we hit 40% deviation relative to M2, I think that's a good trigger to to go short on the market with some long-term puts, and that's kind of the my thoughts on this setup. And yeah, like I said, 40% drawdown expected once it does happen. So that's it for today. I'll jump back to SPY, oops, and show this again. So recap, expectation for today is a bounce here. We go down, potentially a breakout and go like to 645, but make a lower high, which will eventually become the trend. So if you want to go short and are confident that we will not go higher, this is kind of the area where to expect like this previous top, but without a deviation, without this deviation. This area here, and this is kind of like the short entry, and then we just wait it out and wait for this to play out because surprisingly the market would not like a hot jobs market. Obviously it will not like a hot CPI print, and all the other assets except stocks are kind of looking like pricing this in, like oil up, yields up, dollar up. This, which means hot inflation, hot growth, and basically no cuts. Okay, that's it. Have a good one. Bye bye.